Welcome to TheoTrade. This is Don Kaufman, March 25th, 2022, doing the weekend update here on a Friday afternoon. Will bond selling break the back of the Nasdaq? Listen, most of us right now, today's market, have tendency to focus maybe a little bit too much on the equity side of things. That is, equities, indices. Obviously, each and every one of us has watched the S&P, rally back. And in fact, if you bring up the spiders at this point in the game, all right, we're only down now about 5% on a year-to-date basis, recovering quite nicely. I mean, hey, we're just 2 weeks removed from what was a 12% decline. So we have right now what we kind of term that, quintessential rip your face off rally. And we're seeing volatility get crushed back very, very nicely. And that is, if you take a look at the VIX has been straight down, since that, since the rally kind of, ensued. But if you just are focusing on the equity market, or you're just looking at the apples, and I'm going to talk extensively about Apple today, because I've positioned in here, Apple, what is this, 9 days in a row, effectively straight up. You'd be missing the bigger picture looking at equities. You've been missing the bigger picture looking at the volatility crush. Because what I want to kick off this weekend's update with, is center stage. What is the driver of the markets right here, right now? And what is going to be the driver of the markets, in the days and weeks to come? Unequivocally, people, it is the bond market. If you're not looking at the bonds, you're not seeing what's going on. And what is going on? They're getting decimated. Bond selling gripped hold today, rocked them down another 2 and 9 ticks. Now, for those of you that don't necessarily speak bond geek, listen, when the bonds sell off, rates go higher, right? When the notes sell off, look at the decline in the notes. Rates go higher. Why should you care? Listen, rising interest rate environment can be incredibly formidable, right? Now, most of the time when you think of a rising interest rate environment, you immediately, let's look at the home builders. Well, no doubt, the home builders, they're not faring very well. You start to look around outside of home builders, you think about like home improvement stores like the Home Depots. Hey, look, that looks just like the home builders. They're not faring very well, okay? Then you turn around and say, well, what would be the beneficiary of higher interest rates? Maybe the financials, right? The financials, look at that, taken off to the upside. In fact, on a year-to-date basis, the financials are massively unchanged. But there's so much more than meets the eye going on here than just trying to kind of handicap, what's going up and what's going down in a higher interest rate environment. Speaking of an interest rate environment, I'd be remiss not to pull up the TNX. The TNX is the, of course, 10-year Treasury rate index. And if you take a look at it, and this gets a little confusing, but the only thing that you'll notice on the screen, right, is holy huge move. Yeah, you know what that move is? It's not the 25. That's the 10-year sitting at 2.5%. Now, lo and behold, we're what? We're only, just about a quarter into the year. Do realize the year actually started with about 1.6% rates on the 10-year and has shot clear up to 2.5%. On a year-to-date percentage basis, right? Behold. You can't make this stuff up. The 10-year is up 53% on the year. Right? Now, this is the one, of course, that's going to impact your mortgages. This is the one that everybody focuses on. It's not the 30. It doesn't matter if you take a 30-year mortgage. The 10 years where they lay off that risk. But again, if you were to look on the surface and you would think about the home builders or Home Depot, all right, that's just on the surface. There is so much more going on. I want you to think about things like stock buybacks. Why? Because that's why I'm asking here. Will this bond selling, if it persists, is it just going to turn around and just snap the back of the Nasdaq? Because if you take a look at the marketplace, specifically today, the Nasdaq, I almost feel like, it got squirrely, but it got downright lucky that it rallied back up. I mean, the Nasdaq finishing the day almost completely and totally unchanged. Bonds, people, okay? That is center stage. That is the driver of the markets. Now, I'm going to geek out on you here for just a minute, right? What you're looking at here, this actually comes from the treasury.gov website. It's a very exciting website. No, not really. What we're looking at right now and why I'm telling you that bonds are in such a critical area. Down below, well, right here at the very bottom of your screen, and I blew this up the best I possibly could because I know a lot of people are watching this on a video, but that's today's date. It's March 25th. We're just through the end of the trading day. And what I wanted you to see on here is take a look. This is the 10-year, and I'm actually going to kind of just highlight. Let's just cut to the chase. 10-year is trading at about 2.48, right? If you look at the 7-year, yeah, the 7-year is above it. It's 2.56. Take a look at the 5-year. Yeah, it's above it. Okay. Take a look at the 3-year. It's above it. We are seeing a full-fledged inversion of the yield curve. Should you be concerned? Of course. I mean, hey, listen, this is where, Jerome Powell stated earlier in the week, usually people look and quantify the 2-year against the 10-year, right? When the 2-year gets above the 10-year, they're close, but they haven't inverted yet. That's the sign of recession. Don't worry. Jerome Powell already commented earlier this week. Don't worry about it. That's not his sign of recession, except that's been one of the most effective tools to gauge a recession. And you think about, the face of everything that this marketplace and everything that's been thrown at it in the last couple of weeks, and yet the S&Ps are rallying. And again, that maybe drives a little fear. Now, that's not a comment to make you bear up inside of the S&Ps. That's a comment, to the stark reality that the bond market is screaming right now. All right, it's a huge sell. The interest rates are coming up. The yield curve is inverting. I'm not going to sit here and preach to you that the bonds are going to continue to see sell side activity. That's not the point. It's the implications already of the damage that has already been inflicted in the bond market. And I don't think that volatility and the damage that's been inflicted to the bond market has actually kind of reared its ugly head to the S&Ps, and more specifically in this case to the Nasdaq. So higher interest rates. One of the biggest negative implications of this right off the bat, obviously borrowing costs for everything go up. But if you look at debt-laden, Nasdaq firms, this is problematic. But then you can also actually quantify even stuff like Apple. Okay, how does Apple do stock buybacks? Is it a good thing for the board to actually say, let's do some stock buybacks, let's do them in a big way in a rising interest rate environment? It's kind of hard to fathom that they're going to do that, right? We're in a rising interest rate environment, and now the yield curve is inverting. People are going to be talking about recession because the moment the yield curve starts to invert, you're on the clock for a recession. And yet we still see a persistent rally to the upside. I believe what's actually going on right now is you're in the midst of a little bit of a gamma squeeze in the S&Ps. Caught fire. We continue to gamma squeeze. It'll ignore the bonds until you can ignore them no more. It'll actually flip the gamma back over, and we'll start rocking again the other way. But again, center stage driving these markets is bonds. The other aspect, and again, if you think about like headwinds for the market, and there are headwinds for the S&Ps, the commodity market, I don't need to tell you what you have already looked at every single day. I mean, the oil markets are completely out of control at this point. Oil, even last night, cresting back up close to the 115 handle, comes in a little bit. But oil, you're looking at this and thinking some of the volatility has died down. Not necessarily. Okay, the volatility is still absolutely immense. It's definitely died down from 3 weeks ago. but the volatility is still just critical in here. But the other aspect that really kind of resonates with me, it's not so much about oil, it's all the commodity markets. Look what's going on inside of gold. You can look at any of the, obviously wheat, and wheat is, constantly limit up, limit down on a day-to-day basis. The commodity markets and the volatility in the commodity markets is just downright scary. The one aspect that I want to have, again, resonate with you is that equities are to follow. That is, I would fully anticipate that volatility is going to come raging back. Does that mean that it's on the horizon this next week? When you talk about next week, a lot of people have tendency to focus a bit more on the calendar. Like, what's coming on the calendar? All right, plenty is coming on the calendar. All right, there's plenty coming on the calendar for next week. But, lo and behold, I think volatility is probably right around the corner. Any one of this, and here we go, who's just talking about, everybody's going to be talking about CPI numbers and PPI, and it's going to be wild. There's just no question about it. It's going to get downright wild. And of course, you have the employment situation to cap off the April 1st on Friday. Okay, it's going to be an absolute party. I would focus less on some of these announcements. There's no question some of the announcements are going to spark degrees of volatility. But that volatility, you're already seeing it. And that's the point I'm trying to make. You're already seeing it in bonds and commodity, like volatility is through the roof. What's going on inside of the S&Ps? Yeah, it's a gamma squeeze, but, net, it's just the markets get tired. Traders get tired. I mean, we're pretty deep into this now. This war is going on for a full month. Volatility's been extreme, though, even before that. I mean, volatility kicked off before we knew what was actually going to transpire in Eastern Europe. And we're locked and loaded right now in terms of volatility. It's coming back. Just be prepared for it. And that's one of the things that we're going to discuss here momentarily is, again, what's center stage driving markets? Well, now I'm going to get into some of the dynamics of that. Trade ideas and positioning. So obviously, that I believe that bonds are absolutely critical in here. And again, I wanted to put this conversation into context. It's great to say center stage driving markets is bonds, commodities, equities are going to follow with that volatility. But let's put the money where the mouth is. And these are trade ideas. These are every position I'm going to discuss. I presently have on financials. They're ripe for a short. So let's cut to the chase. Let's actually cruise over to the financials. Why do I believe the financials are ripe for a short? This is what I actually term kind of a no way out scenario. That's just my terminology. That is not necessarily trade lingo when I say no way out. So right now, why do the financials look like, this? So there's some upside momentum in the financials. It's because, all right, interest rates look like this. So if rates are going to go higher, you're going to see financials go higher. But what happens if rates were to cool out? Meaning that what happens if rates pulled back? If rates pulled back, financials would probably pull back. All right, I think everybody would have to agree with that. So why would I take, again, a short? All right, and I'm taking a short inside of financials. I just actually took the short today. I'm actually in it in a couple of different ways. If you're kind of curious on here, I'm going to open up the 42-day expiration. By the way, this one will stick out like a sore thumb. If you're kind of curious, does anybody follow his trade ideas? Well, apparently and appropriately, yes, they do. You can see positions are in here, but we're doing just shy of about 3,000 contracts. But what I did in here, it's kind of interesting. I actually placed I did one execution 35 days and did another execution 42 days out. I split up some of the inventory. So we're clear north of, again, almost 3,000, almost 300 contracts done specifically on this particular short. And if you take a look at it, let's get down to the real detailed portion. Why do I call it no way out? So here's my thinking. Okay, cruise over to the bond market for just a second. All right, bonds can go, a couple of different ways. Obviously, the bond market could do what? It could rally back up. So if the bond market has a rally, so let's say bonds rally in here. If bonds rally, that's going to take rates, down. If rates are going to go down, it's definitely going to cool off those financials. To what extent? Well, we'll see. I don't need that much, though, because I'll tell you right now, the XLF position I put on is full degrees of profitability at like the 37 level. Like we're knocking it out of the ballpark at the 37 level. So you just saw if bonds rally. What happens if bonds continue to sell off? Well, if bonds continue to sell off, sellers! So if bonds continue to sell off, what's going to go happen? Rates are going to go higher. If rates are going to go higher, you're thinking to yourself, no. Then the financials are going to continue to rally. I don't buy it for a second. I'm going to tell you exactly what I think is going to happen. If these rates continue higher and those bonds continue to sell, it's going to take the Nasdaq completely apart. It's going to just rip the Nasdaq and rip a hole in the Nasdaq. Why? You can already see it happening today. See, the one thing I can't tell you definitively, I can't tell you at what degree does this bond selling really rip that hole inside of the Nasdaq. Okay. All I can tell you though, if the bonds continue like this, it's going to be devastating for the S&Ps. It'll actually start with like mega market cap. You'll start to see stuff like Microsoft get hit. Apple's going to get decimated. Google, they're going to go after it. Tesla, forget it. Tesla, they're degenerate borrowers over there. Degenerate borrowing. Okay. Nvidia. All of these stocks are going to get hit and hit hard if those interest rates continue to go up. And what I would assume is going to occur if those rates go up, it'll actually start to suck the Nasdaq down. The Nasdaq will actually suck the S&Ps, and it'll break the back also of the financials. So I like the position of the financials. I also like the position of the financials because, frankly, this selling, I think it's overdue for a bounce. And if we do bounce, it'll take rates down. Financials come off that way. So again, it's a position I kind of call like no way out inside of financials. That doesn't mean run out and do 3,000 contracts, but it does mean, again, pretty strong. And I did this position a little further out in time. I got to give myself time to be right, time to be wrong, time to laugh, time to cry. All right. Continuing on. So financials, as I said, they're ripe for a short. You can see some of the financial position. I also don't mind mentioning I'm also short 1,200 shares of the financials. That's just in this account. Net, I'm short about 2,500 XLF deltas. Okay, next in the docket here, trade ideas. Will Apple have a down day ever? So this just goes to kind of a quintessential setup. Here again, the bonds could help me. The bonds continue to sell. I think it'll actually hurt Apple a little bit. But so why did I just step in and, have a conversation about Apple? Because if you take a look at auto expected moves, so this is something I use incessantly, auto expected moves. It's a way to kind of statistically, look at this, but there's one breach, two breaches, and the second breach here is absolutely massive. That is a quintessential setup for an in-out spread. That in-out spread is it is bearish. So I am bearish inside of Apple. That doesn't mean long-term bearish. Let me just clear the air here. I had to use the April 22nd expiration because there's earnings coming up on the 28th. I don't want any part of it. So I got in and pulled off a position here. It's an in-out spread. One strike in the money, one strike out of the money. A little bit of a bearish position in Apple. Listen, I don't need a big pullback. Like I don't want you guys to think he's all bared up with no place to go. Listen, pullback 170. Maybe 166. We're gold, Jerry, gold. Just, get it on, get it off, get on with your life. A lot of the positions that I'm placing right now, SKEW made me do it. Now, I'm just going to mention SKEW briefly because SKEW kind of eludes a lot of people, but SKEW actually is back up. SKEW only calculates once a day, but SKEW is back up to like the 138. I wouldn't be surprised to see that SKEW, it's not calculated yet, but it'll come out here in the next few minutes. But SKEW, I think, will even jump higher, if you will, when the next SKEW print comes out. But at a 138 SKEW, it made me do it. But I want to show you something interesting. When I say SKEW made me do it, SKEW made me in a very large way also want to do the XLF position. If you look at the XLF position, forget about some of the volume, forget about open the interest, and go look at the implied volatility. You realize I'm buying like a 20 vol and selling almost a 27 vol. It is golden over there, right? So I did an extra wide spread, almost. Okay, well, pretty much 6 full vol points, between 6 and 7 volatility points in my favor. And all I'm saying in this particular front, look, I'm buying like a 20 vol and selling like what? 26.8 vol. It's huge. The SKEW is absolutely massive. It's the exact same thing inside of Apple. Like, don't look at this and be like, he's trying to get bared up. How about I'm just trying to trade with the SKEW? Because it's smart. SKEW is in my favor, not massively inside of Apple, but SKEW is in my favor. If I traded the calls, SKEW would actually be against me. Onward and upward. It's Christmas in March. Ladies and gentlemen, the Christmas tree is back. I actually pulled off a Christmas tree trade today. I'm just going to show you what one unit of it looks like. When I say one unit, I've got other positions in here, but it's a 1 by 3 by 4 by 5, but a Christmas tree, it's back in play. This is something I've talked about extensively. If the market stays flat or goes up, I'm going to make about $1,400. If the market actually sells off, I can make as much as about 6,000 and change, and only with a devastating crash could I actually start to take heat, but I'm okay there because I hedge. So hedge, hold, or fold. But this is the infamous Christmas tree spread. And again, the Christmas tree spread, if the marketplace were to crash, and right now obviously the S&Ps are sitting at 450, if the market were to crash below 350, I mean, we're talking about taking off 20-25% of the marketplace. I could actually take a little bit of a hit, but this is a trade that could be done with stocks. This is a trade that could be done with options, futures, contracts. When I say stocks, you could do something like this in the equities, but the SKEW again picked up, and that SKEW made me do it. SKEW made me do the trade inside of the financials. SKEW made me do the trade inside of the Christmas, the Christmas tree inside of the spiders. SKEW is back. I'm back, baby. I have bearish positions on, but I'm going to tell you right this second, I needed this rally. I wanted this rally because I'll tell you, everything I had on where I sold puts and Christmas tree spreads, every single position where I sold premium has come off profitably because of the volatility crush. Okay, every single position. And one other thing, right now I'm also in bond positions. Okay, and I've actually been out there. I've been selling bond puts into the volatility. As I said, this is kind of where the rubber meets the road. One of the things in the trade idea isn't even mentioned in my positioning. I'm out there selling bond puts because, quite frankly, you look at this, you're like, you're crazy, man. You're selling puts in the middle of a crash. Yeah, just crazy enough that I don't mind. I'll take the bonds, put them to me at 138, put them to me at 136, put them to me at 134. Bring the pain, because those that are going to succeed in this marketplace, this volatility, it is not going away. I'm telling you. Okay. Center stage might be the bonds, might be commodity volatility, but the equities are to follow. Center stage is the bonds, right? You got to get ready, though, that volatility is about to come raging back into the S&Ps. And I can't necessarily tell you it's coming back this next week, but I will tell you it is coming back. And this is the kind of thing that you're going to be in for years. Do you think the Fed's going to stop? Okay, they're getting even more hawkish at this point. Inflation is out of control right now. Look at the commodities, it's out of control. Look at the bonds, it's out of control. The bond market, by selling off, is just trying to do what the Fed is not doing. You got to wake up at this point and understand, if you're still out there like, I'm so bullish and so bearish, okay, this is about premium selling. This is about taking good positions. All right. And when I say taking good positions, listen, there's got to be reasons for positioning other than I'm bullish or bearish. To me, SKEW made me do it. Right? SKEW made me do it. The bond market made me do it. Christmas in March. Last but definitely not least, the SPX Expected Move, the mother of all products. So this previous week, we just kind of were grinding to the upside a little bit. Like today, is it a rally? It's up 0.5% with the Nasdaq down. Okay, we're just, again, as I said, kind of grinding a little higher this week. We had a $106 expected move from this previous week of trade. Now, I want to make sure that everybody understands this. So you have this $106 move higher or lower. We didn't hit the $106 move. This next week, oh, you're going to love this. $88 expected move. $88 expected move. People, I'm telling you right now, get ready to rumble. The expected move is really, really tight. It's really tight given the fact that today was even almost like a docile day, right? Pretty chill day. And yet the S&P still moved $50. They moved 50 points from high to low. And you're supposed to tell me that all of next week we're only going to move $88. Okay? No way, no how. I would expect that we're probably going to breach some of those, expected moves. So again, look for volatility to come raging back. As I said a moment ago, a lot of news announcements coming out. Don't bank on any of them. A lot of binary stuff coming out. I mean, listen, this marketplace has seen the face of adversity and still rallied back up. But bonds, volatility, again, commodity volatility, dollar, all of them are still pointing to considerable risk. Like the risk hasn't been taken off the table. The market just got tired. Okay. But I am going to tell you this and leave you with this final thought. Wake up, because it's on right now. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.